Well, hello everyone. As you just heard in the introduction, if you're a startup founder and you're looking for the right investor, that's a huge decision. How do you do it? Is it instinctive? Is it about chemistry? Do you have some super detailed Trello or spreadsheet or whatever? Well, in these 23 minutes or so, in this panel discussion, we're going to try and give you the answers. And on the panel, there's leading venture capitalists and startup advisors. But first of all, let's just start off, Hattie, by how do you know, what criteria should you have when you're a founder and you're looking for an investor?
Okay, so first things first, I'm just going to put it out there. I think this should be talking a bit about founder funding fit as well as founder investor fit. Funding might not be the right path for you, so come back to that another time. But if you're looking for investors and you're sure that you need to fundraise, I think we need to look at both the hard and the soft side. So do you match their thesis? Are they going to actually be able to add value to you beyond just a check? Capital from investors is actually one of the highest costs of capital. So you really want to make sure they're not just bringing the money. And so a lot of it for me is also back to that soft side. And one of the things I think more founders should be looking at is doing due diligence for their investors and asking founders who haven't been successful, not just the ones in their portfolio who've made it, how does that investor behave when things are going wrong? And also, did they deliver what they promised? And how meaningful was that to your success?
Do you need to get on well? Do you need to have rapport with them, or doesn't that matter?
I think you need to trust them. 100%. Depends what getting on well looks like, right? For me, they should be able to challenge you. They're not always going to agree with you. They're going to tell you things that are really hard to hear. But they need to do it in a way that's constructive, that you trust their advice and you want to go back for more.
Okay. Itxaso, is that pronounced correctly? Yeah?
Yes.
Good. What would you say to that? What 2 or 3 criteria should a founder be looking for funding from an investor?
Yeah, I probably don't have that much to add to that. What I would say is that there needs to be very clear understanding on who is the partner within the firm, who is going to lead the deal. I think it's very important. A lot of people look at a fund and think that they are getting money from the fund. In reality, you are going to be building the relationship with an investor, with an individual. So that's probably one of the only things I will add, just because we have 20 minutes, and I just don't want to repeat myself on that or yourself.
Okay, yeah. Maxine?
I mean, I think the one build I would add to that is, as Hattie mentioned, making sure that venture is actually the right thing for you, right? There are lots of businesses, and in fact, venture is right down the end of the continuum of ways to fund a business. As Hattie said, it is one of the most expensive ways to fund a business, especially if the thing that you're building is, $200, $300, $500 million in enterprise value up kind of when you think it's scaled. Weirdly, that's actually a bad fit for venture. And so, when you're thinking about, at the very earliest stage, when you're thinking about building early stage companies, I'd really encourage you to think about, okay, what do I think is the highest range of opportunity here, and what is that enterprise value? And do I think I can get there in a kind of 10 to 12 year period? And if the answer is, it's below $1 billion of enterprise value, and in consumer, maybe what I'm seeing out there at the moment is maybe even 2, 3, up to $10 billion of enterprise value as you think what the scale of this organization is, and you think that you're not going to be able to get to that enterprise value in a 10 to 12 year period, then have a think about that early on, whether venture is actually the right funding model for you.
We'll go on to crowdfunding in a minute and the pros and cons of that. But just on that point, is there inherent always a built-in tension between the relationship between the startup founder and the investor? The investor wants the return, will be more focused on financial returns and cashing out, even though they might really like the startup and want it to disrupt and become a unicorn.
I think it's a really good point. I think there is inherent tension if you get that initial decision wrong, right? If you get that initial decision right, if you are building a multi-billion-dollar enterprise value organization, then your incentives are perfectly aligned. And so what I often suggest to founders at that very earliest stage is you are entering into a 10 to 12 year long partnership. It actually is longer than the average marriage, at least in Australia. And so you should be doing a similar level of diligence on that founder and on that investor to make sure that your incentives are aligned, i.e. you want to build an organization of that scale along that time horizon. What I see happen that's really a shame, I think, is when founders, the only way that they know to fund the business is venture. And they end up with an incentive misalignment because they want to build something that's, say, $500 million or less in enterprise value, and they want to take 15 to 20 years to do that, and then they get pushed too hard to build a company that's faster or bigger than maybe is natural for the strategy.
I mean, you mentioned then about the analogy with the sort of a marriage, and what happens when, and perhaps all of you can answer this, what happens when there's a problem in the relationship between the founder and investor? What's the equivalent of counseling to help them repair the relationship?
So those happen sometimes. So there are different ways to solve those. One way is obviously you rely on other investors that you have on your board. I think chairman, the role of the chairman in many cases, it's really related to those situations in which once the founders and investors cannot get to an alignment. And in fact, they've been very positive in many of the boards that I am sitting of. The second thing is that you can also try to have a conversation with that individual and say, hey, probably we are not enjoying this, I'm not having the right relationship, and you need to understand why is that. I think the most important part is to go back and understand why that is happening. There might be some tension because maybe those investors are pushed to return some capital in a short period of time. They are having difficulties to raise some money. So you need to understand why, because in reality, there might be ways to solve that. And probably by getting another partner from the same firm is not going to improve. That's probably not going to improve, unless it's something very personal. But I don't think it's going to improve, because the rest of the people in the same firm, are they going to maintain the same attitude? So I'd probably say having a conversation and trying to understand why the push in certain direction comes from, it is important. See whether there could be a way to do a secondary for those investors and give them a little bit of liquidity without affecting the progress of the business in certain way. How can we work together? Who knows, right?
Okay, that's good. I mean, have you got anything to add, Hattie, about that? You advise a lot of entrepreneurs, startups.
Yeah, I think two things I'd add. One is we're also talking like, and we all fall into this trap, right? Like venture is the only kind of equity investor. But give me a wave in the room if you've heard of angel investors. Few of you, for anyone who's not waving their hand at me, angel investors are people putting in their own money as an individual rather than as an institution. They haven't gone and raised from other investors. And so they have a very different investing profile, very different needs. They need normally a smaller size return. They can be a little bit more patient. Some want you on that venture growth journey.
Are these older? What are these like? Older, more experienced investors, or I'm trying to picture them?
I mean, I don't think age needs to come into it. I think it's about what do they deliver in terms of network. What do they deliver in terms of experience? They might be often an angel investor will be an exited founder themselves. They might be someone who's had shares in a company that has grown fast and exited. But also we're increasingly seeing, and I'm a huge fan of this movement, the drive to get people who are in big corporations, who have some spare money that they could afford to lose. And we hope they don't, but they could afford to lose it. Important part of angel investing, very risky. And we try and train them to say, okay, how do you add value to startups? Maybe it's because you really know the art of marketing. Maybe it's because you really understand the buying journey, the procurement process for selling to the kinds of company that startup is selling to. So they can add huge value.
And there might be less pressure for a quick return if they've made more money in their career, or they're not looking for that quick return.
100%. And I think it's worth just understanding, like back to this point, what is the investor expecting from this relationship? And I don't mean expecting in the sense that every investor thinks you're going to be the one to return. They know the risk profile, but does success to them look like you're $1 billion plus business, or does it look like they take out a few million because the company gets acquired for a few hundred and they have a nice share. And so I think it's important to understand that. Important as well with funds to understand when do they want the money back. That's going to be determined by what return profile have they sold to their investors. So they might have sold, we're going to give you your returns in 7 years, 10 years, for more patient capital, maybe 12. But that's really going to impact you and where they are in deploying that money. So if they're in year 2, 3, after they've got the fund, they're probably less likely to be putting it in startups at that point, but some still are because they held on to it for a long time.
I think I'd also build on that, which is you're never going to see the profits of your business sitting next to me here on a panel marketing why you should optimize for the profits of your business. And so, VC and angels and other ways of funding your business, they have a marketing budget. Your profits don't have a marketing budget. And so have a think about, actually funding your business from free cash flow early in the journey, right? Often the businesses that are on that trajectory of going to $1 billion, they have a deep loss-making period, which is why venture exists, right? But for a lot of businesses, and increasingly today with AI, there's a lot of businesses you can start that don't have a deep loss-making period. In fact, sometimes they're profitable straight out of the gates. And then maybe you're a better fit for kind of growth stage later when you're down the track. And so I would strongly encourage you to also consider profits. They're not going to be screaming for your attention, but they are the cheapest way to fund your business.
And also customers are better validation than investors, right?
100%.
If someone's actually going to buy it, and I think as founders, we're often a bit shy to make that first sale, but we're less shy to go and tell an investor to give me a huge chunk of your capital. I think we need to be a lot braver on one half of that.
What about crowdfunding? Is that a good option?
Crowdfunding.
Crowdfunding. Okay. Crowdfunding. That's an interesting one. So crowdfunding, personally, I think there is some misunderstanding of what crowdfunding is good for.
Yes.
And I see a lot of early stage companies willing to raise money through crowdfunding. They think it's easy.
Yes.
They think it's easy. You put your project online, people will wake up on a Saturday morning and they are like, oh, let's see where I can put my money in. They scroll through, they find something and they just invest. That just doesn't happen. How many of you wake up on a Saturday morning and do that? Sitting there and read through the projects and raise money. If you think about the more successful companies raising crowdfunding or completing crowdfunding campaigns successfully, those are the majority, over 90-95% are consumer businesses. And they are businesses that already build a big network of customers. Think of a Monzo. Think of a city mapper. When you use every day your app to know where to go in the city, then you get an advertisement, a note saying that City Mapper is going to be racing in 90 days, then in 89 days, 88 days. So for 90 days, you are seeing the same advertisement on your app, so they are not paying for that. Monster, the same thing, right? So if you think about it, in the moment the crowdfunding campaign comes out, they have a huge number of people who are willing to put money in. They've been seeing this for 3 months. They registered their interest already. And so they raise money in a very short period of time. And that happens when you have a big community and you've been operating. So that's usually not in pre-seed and seed. It's after Series A. If you are not as big as Monzo and City Mapper, but you still have a community, but you are after Series A, you might be able to raise a smaller amount of capital. But it should be always whenever you build that community. Now, that being said, there are some startups that use crowdfunding platforms to complete whatever they've raised offline. Think that you have some angels. I go to an angel, I have here committed 50K, 150K, another 75. I have like 6 of them, and that takes me to 750. Maybe I can get to 900 if I put this online. The angels put their checks in, so whenever they're in some traction already, other people will see that this is a good place to invest in, and they might top up that. But let's just not fool ourselves, thinking that you can just go there and raise money from the crowd when nobody knows me and I'm building something in life sciences that nobody is going to understand. I mean, it's a great impact, but it's very difficult.
I think the big myth is that the crowdfunding platforms bring the crowd, and you're absolutely right, they don't. I think also, just to clarify, the reason those ones who already have some of the money dedicated are the ones that succeed. The crowdfunding platforms now mandate that. So you have to have, the minimum I've heard is 40% of your round pre-committed. So you have to have some investors, maybe it's friends and family if you're earlier. You have to have some money already committed. And in the last year, I've heard the ask vary hugely. I've heard some startups where they're really early being asked for 90% pre-committed. And yet I still hear from startups time and time again, Hattie, if I can't fundraise from angels, I'm going to go and do a crowd fund. And it's the wrong way around.
Exactly.
So how is let's look at the big picture. How is Maxine, the overall market for investor startup funding generally?
Yeah, well, I think you just heard some really interesting data there from the PitchBook team to kind of give you a good sense of what's going on kind of across the market. And it was a very EU-focused set of data, but obviously for this audience, really helpful. So we are pre-seed investors. We just invest in pre-seed. So at that end of the market, what we're seeing out there is it's still really hard. Right? It's was really hard in 23. It's significantly easier relative to 23 and 24, but it's still really hard. If you're building in AI, it's much easier to get the attention of investors, at least in the US and in the Australian ecosystem where I spend most of my time. But we are definitely seeing more capital being deployed into the ecosystem. We're starting to see that tick up again. And so great projects in spaces where it's clear that there is a possibility for a huge business to be built.
Any particular sectors within tech? Obviously AI, but...
Right, yeah, so AI definitely is getting a lot of the attention. I mean, just to put some numbers behind that, YC's last 3 batches, they're obviously in the middle of one now, but the 3 graduated batches, the 3 times ago, it was 52%, then 73%, and now 78% in terms of the number of companies in those batches that were building in AI, right? And I think that's an interesting index for you because YC sees probably the largest index of companies globally. A lot of people move to the US to attend YC, so they have a pretty good kind of idea of that. Within kind of other technological fields, we don't do any life sciences, we don't do any biotech or hardware, so excluding that from the data set, we're seeing some strong interest in B2B SaaS. There was a huge flight to the kind of comfort of B2B SaaS in the turbulent times of 23 and 24. Consumer's still pretty hard to fund. We're definitely seeing a lot of folks that would do like blended B2B and consumer in the US market, pulling back from consumer and spending most of their time on B2B SaaS. But I would say I'm seeing green shoots of that changing in the US in particular, because there's some really interesting stuff happening at the intersection of consumer and AI and prosumer and AI. And so I think we're starting to see some green shoots there.
Good.
I will add to that one, maybe fintech, just
yes.
Because I do think it's specifically in Europe, it's a great area. I know that the US had a little bit of a shocker with a couple of businesses, in fact, going bankrupt, but I'm very bullish in fintech in Europe. I do think that many of the most interesting innovations happened in Europe. I mean, if you think about it, chip and pin was invented in Europe, contactless was invented in Europe too. We are way ahead of the US in anything related to payments. There is huge inefficiencies in areas like B2B, cross-border payments. It takes 2 to 3 days to do cross-border payments. In emerging markets, it can take even up to 7 days. So there are huge inefficiencies, and businesses are trading globally. So all of that brings an incredible opportunity in the fintech space, in my opinion, to disrupt the ecosystem. And I'm very bullish in Europe about it, to be honest.
Good. Optimism is good. Hattie, anything to add?
My only caution to add is if you're a startup in the audience who isn't building AI, please don't just write AI somewhere on your pitch deck and assume that will get you funding, because we are seeing so many decks where it's like, we're an AI, and it's not your AI. You have no control over it. You're not actually building anything, and it's so quick for investors to spot it. We know what you're trying to do, and it's not a good look.
All right, good. We've got 3.5 minutes left, so I think apparently, Itxaso, you wanted to say something about the secondary market, which apparently is very important.
Oh my God! No, we were talking about one of the things in fundraising that it's about the secondaries. A lot of founders ask us. I'm a Series A investor, so different to Maxine, where she's investing in pre-seed and seed. some founders come to us and they are starting to look a little bit with a secondary, which means that when you are raising money from investors, you are basically selling part of your shares. You are getting a little bit of money off the table. I think overall, investors, we are very keen on supporting that, specifically after Series A. Series A, you could take a little bit amount, just give you an understanding. It could be from 200 to 500, 700K maximum among one or two founders. But in Series B, usually you could take more like a 500 to 1 million, and so on. You take off the table because we understand that your salary is a little bit lower. Now, this is just a way to give you a little bit more comfortability in terms of being able to focus on your business rather than focusing, hey, I got to get a mortgage and I don't know how to pay the deposit. And obviously, we want you to focus on the business, which means that when you are starting to raise your pre-seed round, you are probably not thinking of that because obviously it's at the very beginning and we are expecting you, as we say, in fact, even to be looking at customers, to be financing your business, that's the best way to do it. But yeah, we were talking about secondaries in the back, and I guess we pick it up the topic now.
Okay, good. Right. We covered a lot of stuff here. One bit of advice for startup founders to find the right funding.
One.
In a few sentences, hopefully.
Okay, one really practical piece of advice. I'm going to give you a tool that you might all enjoy, which a friend of mine started called shipshape.vc. It is a search engine to find VCs that is based off of what are those VCs talking about specifically. So rather than being like, you're a fintech investor, it's going to look at who are the different partners and analysts in the firm? What are they actually posting about? What content are they generating? And then direct, okay, within fintech, what are they really excited by? So if you give it some details about your startup, it will give you a list of investors based on what those investors are actively talking about now, not just what they put on their website as their fund.
Right.
Super important when you start talking to VCs, or before you start talking to VCs, try to understand what are the economics of the venture capital firms. Try to understand what drives VCs like me to invest in companies. Because it is a complete misalignment when I have a founder in front of me and doesn't know how would I make money, in fact. And they pitch something that it will not make me money. And I love your business, I love what you do, but I cannot invest because it will not make me money. And that's a waste of time there.
Maxine, you've got 23 seconds.
So my one suggestion for you is think of your cap table as a strategic asset, and you should place people on your cap table who can be Avengers style, play different roles for the strategic needs of your business. And so use those seats. There's a finite amount of cap table you can give away. So think about what is strategically most important for you and pick investors accordingly, be they angels or VCs.
Okay, great. Avengers style, maybe without the extreme violence. But thank you all very much, and thank you to the audience.